Good afternoon, everyone. Great to see so many people here. I'm Alex Cartwright here with David Peters. We're here to talk to you about our grand strategy to create 100,000 units of affordable housing. Before we get started, though, let me set a little bit of context. Affordable housing, it's a buzzword. It's always in the news. We see a lot of headlines, especially over the last couple of years, about rents going up, even though in some major metros lately rents have softened, and about housing becoming less and less affordable. There's this term in the real estate world that you are cost burdened. You're a cost burden renter whenever you've spent more than 30% of your gross monthly income on rent. And you're a severely cost burden renter when you've spent more than 50% of your income on rent. And both of those groups of people, the cost burden, severely cost burden, those are at record highs right now. And we've seen over 1 million people get added to that group just in the last 2 years. All of that translates into a lot of demand for affordable housing. And but just aside from the investment opportunity that exists in affordable housing, we'll speak to that in a second. But I'd just like to share and set this up a little bit, that affordable housing is something that David and I feel real passionate about creating. And when you're investing in something, when you're starting a business to go after something, you've got to have a mission that will keep you motivated when things don't go well. Because inevitably, there are going to be moments where things are not going well. Insurance doesn't get renewed, property managers are not performing, somebody steals from you, interest rates move, and you've got to navigate and pivot. It's not always comfortable. You try and build in for these contingencies and you try and be flexible and always reevaluate your strategy. But inevitably, when you're taking risks, sometimes things don't go according to plan. And so you've got to be tied to a mission that drives you. And let me tell you about why affordable housing drives me. So, outside of real estate, I'm an economics professor at Ferris State University, which is a school here in Michigan. I live in Grand Rapids, Michigan. And so, of course, as an economics professor, I want my students to understand the power of markets, the critical role that entrepreneurs, property rights, prices, profit and loss play in creating and sustaining wealth and ensuring that we continue to be the richest country in the history of human existence. And I see young people, my students, they graduate, they get that first job, and maybe if they're working entry level somewhere, they're only making 40, 50 grand a year. And then they're hit with a bunch of taxes. And then it's time to go and rent an apartment. And all of a sudden, boom, a third of their income is going toward rent. Or they've got to get a roommate, and maybe they're living in a worse area and in an apartment that's not even as fancy as their dorm room. And I worry that that encourages them, that reinforces a narrative that this economic system is stacked against them, that there's not a way to get ahead, especially when you come home and you're in that not that expensive apartment that is not that fancy and it's not suiting your needs. That's just a constant reminder that there's some, in their minds, perhaps a greedy landlord getting rich off of them, and this economic system is not working for the individuals, that it's built to help the wealthy, which of course is not how markets should work and usually do not. And I think that creating more affordable housing in order to help young people, in order to help people of all income levels be able to save more and be more financially independent, I think that's going to encourage a lot of additional I think that's going to create a lot of good things in the world. And I think that that will change people's perception of markets and capitalism. And so I'm motivated by that mission of creating affordable housing for that reason, because I think that it's an important way to orient our young people toward markets. However, right now you can't build affordable housing. And David, I think, has got some of the latest stats on what it costs to build per square foot in most major markets. But long story short, it's impossible without some kind of government assistance, which comes with a lot of strings and is by nature scarce, it's impossible to build more affordable housing. It's just not economically feasible to sit down and to build something that rents for $800 to $1,000 a month. And as a matter of fact, as we've seen about 14.5 million units of properties that rented from $600 to $1,000 a month get wiped out of the housing stock since 2011. And that's either because those properties were demolished, they're abandoned, or most likely they were upgraded. They were upgraded from a D or C class building into a C plus, B minus class building. And so as current buildings fly, and probably a lot of people in this room purchase that C class building, put in the new floors, kitchens, bathrooms, and bump the rents a few $100. That's a good business model. Those properties are harder and harder to find. That leaves a lower amount of C-class housing out there for the people at lower incomes to occupy. And by the way, that's where the highest occupancy is. That's where the demand is. And so that is where we are interested in looking. And our model of creating affordable housing is by looking at hotels that no longer make sense as hospitality properties, either because the hotel market's become too crowded in a city, or because the hotel is old and not worth remodeling, and repurposing it as workforce housing, usually by converting the hotel rooms on a one-to-one basis to micro apartments. And when you make that physical change from hospitality into multifamily, it's not just a physical conversion. We're also making a financial conversion. We're rezoning, reclassifying the property as a multifamily. We're capturing now a multifamily cap rate, which is significantly different from a hotel cap rate. And we're going to take the property's value from anywhere to 2 to 3x the acquisition price. So this has been something I've been passionate about for a while. But actually, this 100,000 number, all the credit goes to David. It's kind of my personal goal to have 10,000 units of hotel converted properties to multifamily in the next 5 to 7 years. And I remember being at a seminar with David, and we were doing some goal setting, and David writes down on his paper 100,000. And I happened to be sitting behind David, and I was peeking at what he was writing down, and I was like, David, when we had a break, I said, David, where'd you get 100,000 from? It's like, so David, tell us where the 100,000 came from.
Well, I mean, actually looking at the opportunity, I just, first of all, I think that we as, multifamily operators, right? I think we have a responsibility, a social responsibility to, try and provide this housing, because we as operators, one of the big strategies in multifamily has always been to do value add, right? So you fix up the property, you put granite countertops in, you put in, new cabinetry, you redo the bathroom, and then you turn the dial up on the rent 20%, right? Or 30%, sometimes more than that. Mm-hmm. And I mean, as we've seen, right? I mean, I have a chart, and I could pull it up here maybe real quick in just a minute, but that's just, decimated affordability, right? And so when I got introduced to the whole concept of hotel conversions, I immediately said, wow, this actually makes sense all the way around. I mean, it's a win for the investors for sure, but it's also a win for the communities, and it's a win for the residents, right? And so, looking across the country, obviously, personally, I'm not going to do 100,000 units. There's no way I can, but that's not the idea. The concept, the idea is that we build and train other groups, we work with them, and then as a broad group, we can have some, I mean, we're not going to fix the homeless situation. We're not going to fix the affordable housing situation, but $100,000 or 100,000 units is a significant impact, right? And I mean, that's 100,000 households that now have the ability to maybe live someplace where they've never been able to live before, right?
Hello, everybody. I'm sorry I'm late. I had a little run-in with a RAV4, who decided to go rogue and take off and nice little hit and run here in Nashua. So my apologies, I had to deal with that. But Alex, I like what you're talking about, this $100,000, 100,000 units, because when I heard David say that, I thought, oh wow, geez. And then I said, why not? Why not do 100,000? Because like you said, we're trying to create teams of people who can convert. And we create 100 teams, then the 100,000 units is an easy number. And we can definitely do.
Every team does 5 to 7 deals.
Yeah,
150 unit hotel properties. That can easily be done.
So the 100,000 is not an outlandish number. And David, I can honestly tell you, based upon how we are working together and what you've done, accomplished, and how this all needs to be done, you are going to be the godfather or the grandfather of those 100,000 units. So don't sell yourself short, and I'm looking forward to doing it with you. It's going to be a blast.
Well, I'm just excited to be able to provide that opportunity for so many people, right? I mean, it's life-changing for, like I said, the residents. It's life-changing for the community, and it can be life-changing for the investors too, because I mean, there's just opportunity, and like Alex was explaining, I mean, that cap rate arbitrage is just such a powerful technique to unlock value.
Let me show a slide of that if I'm allowed to share.
Can you do that? Let me see. Molly can set you up. I'm also going to find that link to that article you sent to everybody.
Pop that in the chat.
Yeah.
But look at this. This is some data. Can you see this? Okay, Charles and David.
Yeah, that's good.
So here's just some. This is a chart from Marcus and Millichap over the last decade showing that cap rate compression. And you can see where we've even had primary markets and secondary markets converge in terms of cap rates. And that essentially meaning we've seen cap rates fall in New York City and Atlanta, but you also see cap rates falling in secondary markets like your Lexington, Kentucky, or your Des Moines, Iowa, or something of that nature. Cap rates are falling everywhere. And that means a couple things. One, that means that you can be an idiot and make money. You can cycle through 3 different property managers and have your property 85% occupied and have people late on rent and so forth and so on. But if the cap rate goes from a 6.5 to a 4.5 and the building shoots up 50% or more in value, you're fine. And you exit and you look like a genius, even though you didn't follow your business plan whatsoever. But what that means for you and me right now is even though we've seen this spike in interest rates, we've not seen a spike in cap rates. And that will come. I don't know that it'll be a spike. There'll be an adjustment in cap rates as debt matures and folks will have to refinance. And however, the rent may not soften given that there's such a shortage of housing still out there. But what that really means for us is with cap rates where they are, you've got to be able to invest in a way that protects yourself. We cannot rely on the tailwind of this 10 plus year trend of falling cap rates and aggressively falling cap rates at that. And so with the hotel conversion, just imagine being able to buy something at a 10 or 12 cap, or maybe even higher. And then once it is stabilized as a multifamily, get it reevaluated at a 6 cap to an 8 cap. You've really cranked up the value of the NOI, even if cap rates overall are to keep rising. If you are buying at a 12 or 14 cap, you've protected yourself. So the cap rate arbitrage, that's really what the conversion is. We're financially converting from one asset class to another. That cap rate arbitrage spells 2 real important things: big upside, but also protected downside. And I don't know where you're getting a better risk-adjusted return in real estate right now. And at the same time, we're providing a product that nobody else can provide.
Yeah, I just posted that article there. You can see it, and that really brought up some great points about using, U.S. is building more apartments than it has in decades. We're up to $1 million starts in the next 12 months, but not for the poor. And that's the problem. I mean, I wonder if our friend John is on the call. He works in the HR for his company, and he says that's one of the biggest problems, people coming into him talking about the fact that they can't afford their rent and there aren't any other options. And we have all of these units sitting fallow that need to be put back into use, need to be recycled. And that's what this whole thing is all about. And the other thing that blew me away when we started looking at this is, you look at these rents that Section 8 is offering. You look at the rents that LIHTC properties are requiring, and how much money are going into LIHTC properties to create affordable housing. Those things are still priced so high that people who aren't on Section 8 can't afford it.
Right.
And the models that we're coming up with these hotel conversions, we can charge less than Section 8 and still make a wonderful profit. And it just shows you that there's so much room in this. All right, let's talk for a moment. And obviously, for the sake of this record, hey, John Erstein, there he is. For the sake of this conversation, we are not going to disclose number of units, what section of the country, anything like that. But one of my students brought us a deal. It looked fantastic. It looked great. And then, of course, you look at David Peters, and he rips it apart and tells us all why it's so bad. And then he said, but this is all overcomable. And let's talk about this. So we had a conversation with the broker today, and two people on our team are going out there to see the property on Friday. But this is a perfect example of a property. Why don't we talk about it, guys, in general terms, and kind of walk everybody through? Because we might, I would love it if we showed up in Chicago with this property under contract, and we can share with everybody how the numbers came about and how the conversations came about, and maybe even play the recording of our Zoom call with the broker this morning, which was so fantastic. We learned so much, just sitting back and watching the masters at work. So go ahead, David, tell us about that deal.
Well, yeah, I think it's a unicorn in the multifamily world. It's not a unicorn in the hotel conversion world, but basically, yeah, we found a property that's being horribly managed to the point where, you'd consider the property to be like almost a D-class property in an A-class area. I mean, that's the kind of opportunity, right? I mean, when are you ever going to find that in multifamily? That's not even like a reasonable unicorn, right?
That's what gurus talk about at boot camps.
Mm-hmm.
Right. Yeah, exactly. And this
you can't find them, but with hotels, they're all over the place if you know what to look for.
Right. Because you end up finding, these hotels, the reality is they get older and they become obsolete for the hotel market, right? They're always building new hotels, and they're putting in better amenities, and they're doing, this and that. And hotels operating as hotels, they generate a tremendous amount of revenue, but their margins, they don't have a net margin of 40% or something like that, or 30%, unless they're very well run, right? So, they just don't have the money a lot of times to keep them up. So, they spend the money on, maybe customer facing stuff, cosmetics, new furniture or whatever, instead of, maintaining the roof and the HVAC systems and all that kind of stuff. Right. So they get tired, and then, they just can't compete in the hotel market. So they just kind of fall and keep falling. And then the only way they feel they can compete is just keep lowering the price. And then you get into like that death spiral thing we've talked about before. Right. And this property is right on the verge of that whole death spiral thing where, the only way they can get people in is they lower the price. They lower the price. They get people who beat the property up more. The property gets more beat up. They got to lower the price again.
Mm-hmm.
Right.
Yeah.
So that's where we come in. We say,
at some point, it's just not worth remodeling. You'll see the same brand have a new property down the street, and then maybe the old property goes independent, it doesn't have a franchise or a flag on it anymore during the death spiral. And like David says, you see the reviews get worse and worse online. That average daily rate goes down and down and down. And as I heard somebody say that's been in the hotel industry, which is totally right, a lot of people say it, occupancy is not what pays the bills in the hotel industry, right? It's all about maximizing your revenue. That doesn't mean that you rent out all the rooms. It means you keep the prices nice and high and not attract the wrong crowd. And so, yeah, our student found something that is attracting the wrong crowd. And like David mentioned, it's in a great location, but newer stuff has been built. And this hotel, fortunately for us, it's been attracting the wrong crowd for a little while. Now, thankfully, it's not at the point where it's got a reputation with the local police, but you can tell that the wrong crowd has been inside that property for a long time, and it's not making money as a hotel.
In fact, the broker even kind of inferred that, yeah, she said, now you understand the clientele of this property, right?
Mm-hmm. And then David said, it's not the type that flag is looking for, is it? And she said, no, it isn't. No, it isn't. But let me just say that it's amazing how much you can find out about a hotel right from sitting at your desk. And that's basically what we did as little detective work. And I can honestly tell you, we knew more about this property than the broker did. She knew a lot about the seller and the seller's motives. But David asked the magical question, have you seen this property yet? I was actually surprised that he asked that question, but I was shocked by her answer. Nope, I've never seen this property. So she has no idea how bad it is. And she obviously has not done the deep dive that we did before talking to her. And this is what we are going to learn in our program, because listen, part of our program is partnering with us, and we are going to be inundated with leads and opportunities. I'm not kidding you folks. If you have had trouble finding leads over the last 5 to 7 years on the multifamily side, on the hotel conversion side, those days are over. There are so many opportunities out there. COVID made it so much easier for people like us to get out there and find deals, that with the amount of people that we're bringing into our program, we have to teach them how to ask these questions first to determine if we really have a deal or not before they send it over to us and we get involved in tapping our partners on the shoulders and bringing them up to speed on the value of the deal. So, David, let's get into some of the stuff that you were looking at. I mean, I'm not going to tell any tales out of school here, but you happen, and I'm an investor in it, you happen to be the lead on a hotel that has the same flag as this particular property. Now, why don't you tell us what that means?
Well, I mean, it basically means that I, have sort of an inside track relationship. Now, I don't know if we're going to exploit that, because I don't know that we're going to even go the route of, dealing with the flag that's on the property. We have the potential, it looks like, to eliminate the flag at essentially no cost, if that's our choice. But it definitely, I think those types of relationships allow you to gain sort of a first-hand opportunity to look at future opportunities.
Now, you looked at that flag, and when you were looking at this flag, you were actually surprised that this hotel was still in operation with that flag's name on the marquee. Now, why is that?
Well, based on my experience, that the standards, the brand standards that we're held to as franchisees, they would have closed that property down on us. But now I kind of gave away something there too, if you heard what I said. But
no, I think you're good. Don't do it again.
But here's why that really matters. Let's say that property has come in and out of contract now several times, of people that have looked at it, maybe decided it was too much from them. Maybe they couldn't navigate with the city. They didn't know how to buy right in a rising interest rate environment, whatever the story is. Okay. So now that seller wants to get with somebody that they know is going to get to the closing table. That's what that broker wants.
Yeah.
And with David, somebody that is operating that flag, now all of a sudden, this is who that broker wants to have a contract with, because she knows that this group is going to get the deal to the closing table. And that is a lot better than just writing some pie in the sky high price on an LOI and then signing a contract that has a price that no one is ever going to pay, right? If you want to actually get to the closing table, sometimes you don't go with the highest price. And that's the power of the partnership. And now the student that brought that deal in, right, they're going to be able to, because of the partnership, they're going to be able to navigate what can be a great deal, what will be, I think, a fantastic deal, but it's got some complexities to it because of who's on the team with them.
And one thing that wasn't disclosed, and I'll add it in here, was that student of mine has been looking for multifamily deals for several months now, and they've had a gun to their head. They've had a 1031 gun to their head to find a deal. And as soon as we told them about hotel to apartment conversions, within 2 to 3 weeks, they're bringing us a deal like this. And that never would have happened on the multifamily side. And if you sit down, Alex, you were calculating out the numbers, taking the average daily rate and the occupancy and the cap rate, post exit cap rate. They're in a short period of time. There will, and I'm not making a pie in the sky guess here. This is going to make millions in very short order. People hope on that for multifamily. This is how hotel conversions work. Mm-hmm. So this is where it's at, folks.
I would think that property could get stabilized in 18 months, more or less, depending on what our due diligence overturns. And that's another thing, right? It's one thing to see the vision, find the right property, negotiate with the city, negotiate with the franchise, and et cetera. But then the operations are not exactly simple. It's not as straightforward as running a regular apartment deal, especially at acquisition. In order to keep the cash coming in, the best thing we do or the best thing I think you can do is to continue to operate it as a hotel. So you need to know a little about the hotel finances to determine if it's going to be able to make money, if you can compete, and how much money you're going to make as you're leasing up. And so we looked at this one. And David, what's your impression of this property's ability to make money as a hotel during the transition to multifamily?
Well, I'll tell you, I have done multiple previous projects, and I don't think I've ever had a property that had occupancy above maybe 20% when I acquired it. And that 20% was probably 100% that I want to get rid of. So basically I'm almost starting from ground zero almost every time. And this property, while, the clientele, there's certainly issues with the clientele that need to be corrected, but the property is operating at 50% occupancy now.
Yeah. And I tell you, there's no better feeling than getting a text on a Friday afternoon from David saying that our hotel has 100% occupancy for the weekend. Like, all right. That feels good. Yeah. Hey, let's take a look at this question from Brett Shaw. This is a great question. And this actually came up on our conversation with the broker today. We had some discussion about the issues with what's going on in the property. And we were concerned. And listen, Brett, all of this ties into how you're drafting your letter of intent and the amount of time you're giving yourself. And so, these guys, you're always walking a fine line between hotels to hotels and hotel converter to hotel owner to post ownership into a conversion, meaning, hey, they just want to get rid of the property. They don't want to wait for you to find out if you can convert it to a multifamily, and zoning is always an issue. So the conversation we had with the broker today was that, hey, you know what? These guys have already been through two contracts that have fallen out. They've already had conversations with the city. The city has no issue with converting it to a multifamily. Now, Brett, we all know brokers lie. Don't believe anything anyone says. Get it in writing. But now that we know that they've already had these conversations, I'm more inclined to add a provision in the letter of intent saying, we want to make sure that what you said is right. If what you said is right, then there's no problem, right? So let's put this in here to protect us from a thing that you said is going to be no problem. That's how, I will write the letter of intent to make sure that it gives us that protection. And, probably, Brett, because I'm the one writing the earnest money deposit check. So that's why I want to make sure that we have that protection in there. But
by the way, Charles, isn't it right that everybody that comes to the event in Chicago, they're getting a copy of the letter of intent that you've drafted, multifamily attorney himself, and that we're using making these offers. So all of these provisions and exclusions that aren't traditional to a multifamily deal that you need in your LOI for these conversion deals, everyone that comes is getting a copy of that, right?
That's right. That's right. And when people become our clients, they will also get access to my investor marketing system, which is my CRM that I've developed for all of my multifamily investors. We're adding a new component for those people in the hotel to apartment conversion system, that not only do we give them the letter of intent, you're going to get all of the hotel and hospitality properties from CoStar. You're going to get 8,500 independent hotels loaded into your CRM on day one. You're going to get a quick analyzer so that you click on the hotel's name, you fill in a couple of blocks. If they're not already filled in, you hit enter. It does a quick analysis for you, tells you what your purchase price, your offer price should be. And then you can hit another button and your letter of intent is printed for you and ready to be sent, all within the same system. I've always wanted my system to do that. Couldn't get it done with a couple of the other vendors that we used, but because this is custom designed and I'm the one writing the contracts, this is what you get in the system. And it's because there's so many deals coming by, I want you to move fast. And
to answer your question specifically, Brett, how much due diligence? So it depends on the city exactly, but somewhere between 60 to 120 days. And a lot of these cities do not have an established process for handling this kind of thing because it's new. Some cities do. Almost all of them do not. What I do always when I'm doing preliminary due diligence, go to the city's website, pull up their master plan, and see if it's got terms in it like affordable housing, adaptive use, adaptive reuse, all
workforce
of these
housing,
workforce housing, if they want more of it. All of these things signal that they're open to this idea. In most cities, it's part of their goals to create more affordable housing. And if you can sit down with some folks and get them to take you seriously and say, I'm not asking for any handouts here, I want to be able to create more affordable housing, they're going to be open to it. And then there are sometimes more nuanced conversations about what type of building codes, et cetera, is the hotel going to need to comply with. And at that point, you bring in a veteran like David Peters, or what you can do is look for an architect that's done that kind of thing before and is well known by that municipality. That's what I've done, and hire that architectural firm to help you shepherd the process through the city. But yeah, 60 to 120 days. So notice, not like a multifamily deal, right? A lot longer.
One thing that you need to understand the way this letter of intent is written. It's written in such a way that the seller doesn't know you're looking to convert. And when you're talking to the broker and you're talking to the seller, don't you be the one to bring up conversion, because when you do, they will negotiate harder because they know what the value of the property is as a hotel, but they think that they're right, that the property is, as a multifamily, is a lot more valuable, but you don't want to pay that. So negotiate with them as if you're buying a hotel, and we have to write the letter of intent so that it doesn't tip them off that that's what your intent is going to be.
I think there was the first part of that question. I don't think we had addressed yet. And he was asking about like how often these deals don't make it through. In other words, how often does the rezoning essentially fail? And I mean, I would have said, pre-COVID, I would have said maybe 60%. Now I think it's probably closer to 25. And the other thing is, as an investor, we have to look at a plan B if we're, when we're closing, right? I mean, and oftentimes, if you buy the property, right, which we do, we negotiate hard on that property, you can run these things as extended stay hotels successfully, oftentimes without going through the full conversion. And that's kind of our plan B, right? We're, so that we make sure that we still have a good exit, even if the rezoning doesn't get done. But most of the time now, I think, cities are much more amenable to it. And there's ways you can kind of use levers to kind of prod them a little bit, I guess I'll say, to come over to your side.
Just to give you an idea, and I'm going to address this question in just a moment, but this property was in contract first time by another multifamily converter. And it fell out of contract because the rates were starting to go up about the time that it was under contract. But let me just tell you, the number that we have that we're going to be offering is 50% of the amount that guy had it under contract for. And it fell out of contract at a lower price. It's already dropped down millions right now. Remember, one of the things I always say is make the offer that's right for you, and then walk away. And that's exactly what we're doing here. So, why didn't the other guys get it? They were multifamily converters, but I got to tell you, there's so many unknowns in a multifamily transaction, in a hotel conversion transaction, that you've got to leave yourself a lot of room for mistakes, and you got to be prepared for them, and you got to price your property the right way. That's why I see this question here from Ken Singh. Why should I take your program when there's so much information on YouTube? Good, the bad, and hell. All right, I don't know. Listen, I don't know if Ken's coming at us saying like, "What do we need you for?" Hey, listen, go learn everything you can on YouTube. Then when you want to close a deal, come see us. I mean, part of the stuff that you're not going to see, and I'm sure the student who might be on the call right now, and I don't want her to talk because I don't want her to give anything away. Not that she would. I'm just saying when somebody sees her on here, they might know who she is and find out. We don't want to do that. But this student has the three of us as resources because she's in the program. And I'd like to think the three of us, with our knowledge base, with our experience, with our Rolodex, can bring a lot more to the table than a YouTube video. But hey, Ken, give it a try. Let us know how it works. And then if it doesn't, it's a big tent. Come on in.
Yeah, I think the big thing is there's like so much depth to this topic, right? I mean, there's just so much to know that we've learned over a period of time, right? Experience, education. I mean, it's just, you're not going to know what you don't know. And unfortunately, in an hour or two YouTube, I mean, they're going to tell you more of the story probably than the execution.
And look at this guy, Michael Lefebvre. Not much info on YouTube regarding this. Let me tell you, this guy probably graduated from high school by going on YouTube. Mike Lefebvre did. He's incredibly successful, and believe me, I bet you he found this guy. I know has probably done a deep dive on YouTube about all of this information because he owns one of the historic buildings here in my hometown, and I had him on my podcast, and I remember asking him, how did you find that deal? Like, how did you get your hands on that historic building he's going to convert to apartments? And you know what he said, Alex? Craigslist. Yeah. So if this guy says you can't find any deals or any info on YouTube, I believe him. So thanks, Michael. And I'll see you in Chicago. He's probably right down the street right now. But I'll see you in Chicago.
Well, I think also though it's that we're going to do a class in Chicago, and it's going to be 3 days back to back of teaching, and you're going to leave with a book this thick on everything that you need to know to do one of these deals. But we're looking for partners. That's how we get to the 100,000 units, right? Like David said, we want to form these groups, 3, 5, 7 people that work together, all have different skills, and so that as a team we can get to 100,000 units. If you go out, I go to real estate conferences and all the time, like a lot of people on here probably do. There is no conference on hotel conversion, right? There's no program to be part of. There's no community to be part of. And so we're creating the Hotel Conversion Summit, where people can come together and be true partners, co-owners with each other in these deals. That's what's happening in Chicago. So YouTube is definitely not giving you that.
Yeah. Let's talk about that in a moment, but I want to talk about Lama Brian's question. And folks, from now on, I'm only going to choose questions that are 5 or more lines long. That way I can cut off Alex's face. I don't have to look at Alex's face. I'll look at him stand up now.
Right.
Hey, let's talk about this right now. And this is one of the beautiful things about what we're doing. Now, hotels to apartments is, in our estimation, easier than offices to apartments, though there are going to be plenty of office opportunities out there. The conversion aspect is what makes it a lot harder, okay? Mm-hmm. We can do everything that we're doing without any government assistance. And that is huge. I want Alex to speak about LIHTC, affordable housing, in just a moment. But anytime the government's got their hand out giving you something, they're taking something for themselves as well. And we don't want any part of that. I mean, what we try to do is go in there and solve a problem for government that government created. Mm-hmm. and work with them to essentially leave us alone, to let us go and do our thing. When we walk in, like in some of the cases, some of the properties we're looked at, one of the issues is always, and we're going to talk about this in Chicago, is zoning. And the zoning is, does the hotel, does an apartment building fit the zoning? You might think to yourself, why wouldn't it fit the zoning? It's people staying one nights versus people staying long term. You have to understand the city that you're working in. Not only have to understand the zoning laws, you also have to understand the building code laws, because that is impacted as well. Mm-hmm. So we try to stay away from the government as much as possible, because nothing good has ever come from the government. Now, Alex, why don't you go ahead and talk for a moment, for everybody's sake, about a LIHTC?
Yeah. So people say they pronounce it LIHTC. You all have probably heard of the low income housing tax credit buildings. And by the way, let me just say generally here, if you've got any building that's got some kind of subsidy or credit for property taxes, or it's got some rent restrictions, or you took some kind of money and now there's some restriction on how you can operate the building, you're getting dinged on the cap rate for that. You're not getting valued like every other piece of multifamily. And I don't want to sound ideological, but like my license plate says free market. And so I'm proud to just use people's investors' voluntarily contributed money in order to create affordable housing, and not have to use tax dollars, which is really money that was either printed out of the air or taken from somebody else to create somebody's housing, right? But so LIHTC, low income housing tax credits, the government creates, these are tax credits, distinct, of course, from tax deductions, meaning these are almost like checks that the government hands out to you. And the federal government distributes low-income housing tax credits to the state. The states have got different agencies that hand out these credits. Every state does it differently. They're all just plagued with corruption. Just Google corruption, LITCA, low-income housing tax credit, and you'll see. But the incentives are set up horribly, because you get these tax credits based off the cost of constructing a new low rent multifamily. Okay. So the more you spend on construction, the more tax credit you're eligible for. So the developers that get these credits have such a strong incentive to just waste money. And this does not mean that they're building a high quality building whatsoever. As a matter of fact, if the building is behind and they're on certain maintenance issues and they don't have enough in reserves, they can go back and get some more tax credits in an emergency situation. And so they don't have they have an incentive to waste money and construct these things poorly. And they're handed out to all the different cronies. But the other thing is, we still have an affordable housing crisis, even with all this money that's going to LIHTC, which is just lining the pockets of the most politically connected developers. And these buildings are not worth market rates when they go to trade because they come with all these restrictions. Usually, if you take LIHTC money, then not only are you're capped on rents for something like 20 to 25 years before the building gets uncapped. That building is not getting appraised like every other multifamily. And then even 25 years later, everyone knows that these things were built with shoddy construction because they were just built to break even so that somebody could cash out on the tax credits. That's not what's happening here, right? We don't need anybody's assistance. And this is not charity, okay? Where else are you getting this kind of cap rate compression, especially in the uncertainty of this economic environment, other than hotel conversions? Like if I could just dream up the best investment, of course it would be multifamily, but I'd want to be in the section of multifamily where there's the most demand and where supply can't expand. And I'd love it if there was demand for it, whether the economy grew or the economy tanked. Well, guess what? People are going to need $800 to $1,000 a month apartments in every economic environment and every major metro in this city, or in this country, rather.
Let me just Brett Shaw brings up this thing. It looks like Atlanta, multifamily broker in Atlanta, and he's got tons of connections. But this, folks, this is going on across the country. This is, I had to listen to people, last 7 to 10 years tell me that the South and the Southeast is, that's the hottest spot for multifamily. And that's where you got to go. And everybody goes rushing down there and everyone's paying more and more and more for the properties. This opportunity is in your backyard. COVID impacted everything. And now the opportunities are there for you. You don't have to look far. You can go wherever you want. But I mean, as you can see, Brett's telling us down in Atlanta, there are tons. The properties that we're looking for that we've already looked at, they're not in Atlanta. They're all other places in the country. There's one other thing I want to talk about.
And that doesn't mean Atlanta's a bad market, right?
No,
what it means is you've always heard from other people, you gotta be in Dallas, you gotta be in Atlanta, you gotta be in Orlando, you gotta be in Miami. Those are hot multifamily markets. This model, you could make it work in almost any city, right?
Every city.
Well, how many hotels do you think there are in the U.S.?
Well, I've got 8,500 already in the system, and that's just the independents. And those are like the non-flagged hotels. So what's the number? 100,000? 50,000?
Higher than 100,000.
Really?
132,000 hotel properties in the US.
And people are chasing after mobile home parks. They're not making any more of them. This is where the opportunities lie, because not only is the product available, but the customers are in demand also, are out there for the pickings. So that's definitely.
We can make these deals work at a 12% interest rate if we needed to.
Yeah.
I mean, imagine when it goes back to a 5 or a 6.
Yeah, right. Exactly. I mean, that's how much room there are in these numbers. It's unbelievable. Now, let me just kind of explain something. We're gonna, you can work with us at different levels, and we're gonna roll that out for everybody in Chicago. And as Frank says here, that you've heard me downplay the passive investors. How to make multifamily millions through passive investing. Well, if anybody does the math, and I actually have a calculator on my website to show people that when you're a passive investor in somebody else's deal, you're like the lowest in the totem pole of a multifamily marketing deal, and nobody makes money at that level. What we're doing, the type of deals that we are looking to structure are with partners, joint partners, not LPs, all GPs, all of us working co-equally together to work on a deal. So if you've been looking to get into a property and be a one-on-one owner with other people in the property, that's the type of structure that we are looking to do. We're not looking to go out there and raise $5 million from 35 LPs. That's not our model. We want to have 1,000 individual groups out there to be partners with, and then use the Warren Buffett model, where we don't just pay a 7% distribution every single year, and we're not looking to cash out and sell the property in 5 to 7. We're going to grow this thing. We're going to buy more. We're going to refinance. We're going to buy more properties, buy more and more, so that everybody in the partnerships ends up like an investor in Berkshire Hathaway. That's our model for our business. So when I see things like, let me just find the, where was it? Let me see. Oh, I was looking for somebody where somebody said, okay, right here. Maybe it was Brett again. Makes how can I get my hands on that LOI? I'd love to help you, bring you all some deals. Well, that's the thing is, we're going to be working with our clients and giving them access to us. They take first. If you bring us a deal and you're not in our group, in our partnership, well, you better get a bird dog or some type of a contract with us ahead of time, because we owe you no obligation to work with you. We've got to take care of the people that we came to the dance with. So make sure you become a client of ours. Don't just start sending us deals, because we owe you nothing. And I'm not saying that because I'm a tough guy. I'm speaking as a lawyer. When you have a deal and you don't have it under contract and you're just sending it to us, we owe you nothing. You better get it under contract and contact us then, or you would better have an agreement with us that if we take that deal and we run with it, you get some form of compensation. That's the way it works. No more Mr. Nice Guys. I've seen too many people think that they're going to, start in this business by just sending us deals and taking a look at it. Guys, we get them all the time. We want to work with the people that have signed up with us. If they bring us a deal, they get first dibs. If you send us a deal, well, if we don't have a contract with you, we can't work with you. So Brett, I'm just saying that, as your brother, man, I don't want to see you get screwed, and don't put me in a situation where you think you're entitled to some compensation from me if we don't have an agreement. Okay. So I just want to stress that point, but I still love you, Brett, and I hope I work with you.
Let's talk I want to touch on, Mr. H. Patel's comment here about 60 to 100,000 a key.
Hey, be careful who you're talking to here, Alex, because this guy probably already owns 1,000 hotels. He might be that Patel.
He could be. And if not, we'll help him own 1,000. 60 to 100,000 a key. I don't know if you're looking in
in Manhattan
or Miami Beach, etc. But again, without giving away too much, even this morning when we're negotiating with the broker, we're looking at a hotel in a high quality major metro, high quality submarket. This hotel is ripe for conversion. We're talking about in the 40s per key. I've got property under contract in Houston right now. Brand new kitchens in 100 units in a strong submarket of Houston. I can tell you where it is. I've got it under contract. And I'm at 47,000 a key. That's with brand new kitchens in every room because they were converting the property to extended stay. I've got another one under contract, 146 units right outside of Sugar Land, Texas, which is a high-end submarket in Houston. And I'm in the low 50s per key on that one. Again, brand new kitchens, just put in every single unit, brand new parking lot, brand new roof, so on and so forth. So at 60 to 100,000 a key, like your intuition's right. That would be very hard to be viable. But I've got others, stuff that does not have kitchens in it already. Like I'll tell you some, these are real numbers, stuff I have under contract right now. I've got another one in Texas under contract right now. It's a smaller property, 39 units. Okay. And I'm under contract now. 19 of them have kitchens, and I'm at $23,000 a key. And by the way, that's a property with a brand new tin roof, all new windows, and I'm getting about $250,000 seller finance. And this is all because, folks, the hotel market is not hot, right? Nobody is beating down these owners' doors to buy older hotels. And there's always a newer hotel down the street that's got better amenities and the latest, greatest finishings and the new pool, and they offer you points and all the rest. But these older buildings are still in great locations. They've got great amenities, and they're ripe for apartments.
Hey, Alex, let me just bring David in on this because you're talking about deals under contract. Let's talk about deals that have been closed. David, your Thomasville, what was the tell me the per unit acquisition price, and tell me what the market is right now as a multifamily.
Oh, as a multifamily? Okay, sure. Well, I mean, we bought this property as a completely remodeled property. I mean, they had spent $2 million remodeling the whole property. I mean, it was turnkey as a hotel. Now, it didn't have kitchens in every unit, but it was turnkey as a hotel. And we got it for $39,000 a door. The property across the street, which was not remodeled, was listed at like $73,000 a door. I think the hotel or the apartment market there, you're looking at maybe just slightly over $100,000 a unit for the hotel market.
Yeah.
Or, I'm sorry, the multifamily market. I keep saying hotel market.
So Patel, your numbers could be absolutely right, and that could be the right number, but it depends upon what the value of the units as a multifamily studio or one bedroom are after the conversion. If they're worth $200,000, yes, then we're going to pay $100,000 for it. But the other thing too is Alex mentioned a 39 unit that he's got under contract. Folks, they don't all have to be these big 150. Like we do not espouse the old go big or go home theory that some people are talking about. We're looking at putting together partnerships of people that can go out and let's take care of this. Let's take down this 39 unit, convert it, turn it around, refinance or sell it, pull the money out. We'll go do it again somewhere else. Mm-hmm. I mean, we're talking about moving as quickly as we possibly can, and it doesn't have to be a big number. But let me just say, the deal that we're talking about that we are trying to get under contract, I really want to bring it to Chicago and show the people that when you become partners with us, this is probably a deal you're going to be in. Mm-hmm. And we're going to show you the numbers, and there will be people in Chicago that if we get this deal under contract, they will be partners on this deal, and we'll show you what type of return. I mean, I don't want. We're talking millions once we're done the conversion of this property. So I mean that's. I
mean, we can, if you want to take a second, Charles. Like let's run the numbers, run some sloppy numbers. Are we out of time?
No, are we up? Oh yeah, no. Let's keep going.
Just run just the sloppy numbers real quick. Let's say that you got a property and you're able to buy it at $35 a door. You spent $10,000 a door on upgrading the kitchens. By the way, I saw in the chat something about adding kitchens everywhere. Absolutely, that can be tough, and you got to look at your due diligence and make sure the construction will allow for that.
Well, Alex, I think they were talking about office.
Oh, for office, it can be hard. Sure.
Yeah.
But let's just think here. $45 a door, okay? And for the sake of keeping the math simple, let's say we're talking about a 100-unit building. So we're talking about $4.5 million, all right? Let's say that we're going to assume an income per unit of something like $925. Now, by the way, we'll talk in detail all about how you can not segment the electric or the water so that you can make money off of that by selling a utility package, how you can sell internet and cable to the residents because the hotel's already wired up for that. A lot of times there are already TVs bolted on the wall. This is an income generator. And we'll talk about how to monetize the amenity spaces. So let's just assume this is $925 total income from the unit. Maybe the rent is $800 or $850 or something. I'm using some very low numbers. So let's say $925 over 100 units. That's about $1.1 million in gross potential rent. I think you can operate these things at a 40% expense ratio or mid 40s, but let's be conservative here and say 50% expense ratio. So we got about $550,000 of NOI. Now, it's all studios, it's workforce housing. So maybe we don't get the lowest cap rate that in the city, but that's okay. Let's say we got a 7 cap on our $555,000 NOI. Okay. Now we're talking about $7.9 million. $7.9 million on a building that we paid $4.5 for. What is going to happen that causes an $800 or $1,000 a month apartment to not be economically viable anymore? What would have to happen to the economy? Think about what is Apple, Amazon, Google, Facebook, what are they going to invent to destroy demand for an $800 to $1,000 a month apartment that we bought for $45,000 a door? That has got to be the best risk-adjusted return there is right now.
Now, take a look at the two things. First off, if those are the numbers, once you're done the conversion, you'll never have to worry about the debt coverage ratio. I mean, even at the higher interest rates, this property is going to cash flow very nicely. And this is what was mentioned early on. And it's the whole concept of cap rate arbitrage. We are probably buying this property when you figure out the numbers. We're probably buying it in the mid-teens on a cap rate basis. And we're converting the asset to a different real estate class, which brings it down to a 7 cap. And one thing that Alex talked about when we're in Fort Lauderdale was the concept of the durability of income. The cap rate is a measurement of the durability of income. When you're at a hotel, the income is not very durable. You got to sell your units every single night. When you move to a hotel onto an apartment, it's a lot more durable. People show back up every night. They sign a year-long contract. So therefore, you're dealing with a lower cap rate. So we're buying in the mid-teens and refinancing or owning the property in a very conservative cap rate. Now, let's do the flip of that. What happens today if you bought a property at a 5 cap and the interest rates have gone up, the market's turned, and now it's a 6 cap? How much money have you lost because of that cap rate arbitrage moving in the wrong direction? Here we are moving all of our cap rates in the absolute right direction, and it's what we were all trained to do on the multi.
You've lost about 20% of the value of your property moving from a 5 cap to a 6. And are you going to be able to move the income up by 20% and keep the expenses the same? Is that where you want to is that what you want to write in your pro forma? Because that's just not happening. And who wants to take that gamble? I'd much rather buy a workforce housing product in the teens, right? In a great location and hold that for the long term than buy something at a 5 or a 6 or a 7 in the multifamily world. David, looked like you wanted to say something.
Oh, no, I was just agreeing with you that it's, the sensitivity to cap rate increases dramatically as you get to lower and lower cap rates, right? And while we're doing cap rate arbitrage, we're not arbitraging from an 8 to a 4. We're arbitraging from a 12 to a 6 or a 14 to a 7, right? So our sensitivity is not as high either. So I mean that just makes the investment safer overall, and the cash on cash is so strong in a lot of these properties. I mean, you can certainly hold the property long term, and it can be a powerful.
And that's what I'm interested in doing, holding them long term. I mean, when you've got long-term partners, right? That's what you can do. Nobody's got an incentive to become a transactioneer, get the acquisition fee and then get the disposition fee, right? Quickly come in and out. These are things we'd love to hold for the long term. Let me say one more thing though about refinancing. not only do you take the advantage of the cap rate arbitrage, but when you go and get agency debt, part of qualifying for agency debt is your affordability score when you get a Freddie Mac loan. And I've had Freddie Mac brokerage guys tell me about how they've seen hotel conversions, hotel converted properties get better interest rates than the B class multifamily down the road because they have such a high affordability score. And so you absolutely, and by the way, with Freddie Mac, you can get 90 to 100% loan to cost financing. So once you hit that 90% occupancy, you can start the refi process for really low rate fixed term debt that sometimes the B class guys can't even get.
But you know something, Alex, that sounds like something you can learn on a YouTube video.
Well, I mean, maybe you can.
No. Let me tell you something.
YouTube
I'll joking aside.
I haven't met a partner on YouTube though, right? Look. Here's the thing. In every one of these deals, though, there's always some new wrinkle. Like, we don't quite have enough parking to satisfy the city, or we got this funky room shape, or we got to negotiate an exit from this franchise, or we got to find the right property manager, or we got to find the insurance that'll allow us to run a hotel as we're leasing up for apartments. There are all these nuances, and you've got to know who to pick up the phone and call, right? Yeah. And everybody in this room has dealt with those situations before, and they know who to call, and they can brainstorm with you. YouTube can't give you that. Like, nothing against self-education, right? Hope you go and learn the basics, but this is about people that want to collaborate together to get deals done. That's what we want to meet with in Chicago, and that's why we're calling it a summit, right? There's no other group out there, and I'm so thankful that Charles had the forethought to create this, and that I got to be involved in the first one in Fort Lauderdale. And we want everyone that's interested in this to come together so that we can work to take these deals down.
And I promise you, when you come to Chicago, you will hear more from David Peters. I'll tell you that right now. One of the things, David, that I want to get you on the record for here is, some of the things that have creeped up on the deals that you've done that you never saw coming. One of them, I obviously I'm in several of your deals, so I hear these things, I see these things firsthand. One of them is the electrical system in Thomasville and how that impacted the deal. Do you know? We want to speak to that?
Are you sure you're talking about Thomasville?
Yes, I am, David. I know exactly where the electrical engineer came back with a report that said that it's large enough to handle the stoves, which had a direct impact.
That's Overland Park.
Oh, there you go, changing everything on me now. Gosh, I own so many hotels with you, I can't keep them all straight.
Yeah. Yeah, no, that was big news for us. I mean, obviously, the value of those units with full-size stoves in them versus, which is very common, is to have cooktops in these units as opposed to actual stoves. Mm-hmm. And so by being able to, put in a stove because we have the electrical capacity to do it, I mean, that may be as much as a $50 rent valuation increase or something like that. I mean, it's pretty significant.
Mm-hmm. Hey, I love this Ken Moncrief guy. He's giving me a hard time. He says, that sounds a bit like bragging.
Hey, maybe it is. What's wrong
with
it?
Is. Ken, if I want to. I could do it all day long, Ken.
You notice how I haven't said how many doors I own?
No. Let me say how many doors I own. Compared, and it'll be paltry compared to yours, David. So, but also, I mean, you're the situation, every single deal that you've done, David, has a great story to it. And, and then how you have overcome all of those issues and made the deals fantastic. That's the type of thing that's why you need a team on your side that knows what they're doing, because every one of these deals is going to be different, but the profitability is not unique.
Yeah, conceptually, they're very similar, but unlike multifamily, implementation-wise, they can be very different, right? And they're just, I mean, people do a new build and it's a pretty defined process, right? People do a value add multifamily, it's a relatively defined process. When you're coming into these hotel conversions, I mean, you have the issue of, how the city is going to work with you on them. You have, the issue of the condition of the property currently, what types of, code variances you can get or can't get, or, I mean, every one of these deals, I mean, to say the devil's in the details, I mean, that's just, it's cliche, but it's true.
Mm-hmm. So listen, we're going to wrap this up here. We would love to see you all in Chicago. We have, or wherever we're having our event. And obviously many of you will see this again. I think if anybody has any questions, please type them in right now. And let me see, just to make sure that, let me see.
While you're doing that, I'll just say Charles has done a great job on his podcast, putting together a mini series, all of our content on hotel conversions. David and I together, once just me and other times just David. And if you're looking to be one of the YouTube learners and not going to come to Chicago, at least check out the podcast.
For sure.
Let's see. All right. Well, let's see. Okay, Ken, there it is. What if I can't make it to Chicago? Leo, I don't want to hear your excuses. Get to Chicago, buddy. Come on. Dustin, not currently planned. Do we have another event? So try to make it to Chicago.
We're going to be by we're going to do some more events, but how many partners are we looking to put in the group right now, Charles?
25.
Yeah.
25.
So
we're not looking to have 1,000 people in this thing, right?
Not day one, you just can't do it, right? I mean, we need to be very hands-on with this.
And the thing is that the 25 is intended to have 5, that's a 25-person cohort with 5 partnerships built out within those 25. So we get this first deal under contract, we're ready to do it. Out of those 25 partners, who wants to be a partner in this deal? Who wants in? Okay, we're fully vested or fully answered. So we're going to go out and get another deal. Whoever's left, we're going to keep doing deals until all of those 25 people are in the partnership. They all have their own deals going on. And then then that 25 works together to do more deals. And this is what we call the Warren Buffett model for multifamily investing. Is you start out small and you just build and build and build. You don't sell things. You don't put your money into a multifamily deal run by some GP and 35 LPs, and they sell it in 5 years, and they've been giving you 9% distributions that you've been being taxed on every single year, and then you can't take advantage of a 1031 exchange or a cash out refi, and then you got to start all over again.
And it's tough to take full advantage of the depreciation in those situations too.
Depends on how you own it, and so it's there's a huge issue here where our model is designed to create partnerships that grow to be millions, and that's the whole idea behind this concept. We don't want to be that passive investing guru who there's all. Just like multi-level marketing, there's only one guy making the millions, and that's the guy at the top. We want everybody starting out at the bottom so they can do it for other people as well. So, any hotel recommendations? Yeah, you can stay at the Holiday Inn Express and watch a few YouTubes, and maybe you might be able to do this.
He won't let that go. No, where is our event? It's at a Hilton and outside Chicago. What's the Hilton name? Oak Glen. I don't even know.
Go to that website that I put on there, hotel2apartments.com. That'll take you right to the hotel. Is there any difference between converting hotels to units, converting apartment buildings to condos? Totally different. We could do a whole other lesson on that, but the thing is,
certificate of occupancy, start there.
Yeah, I mean the thing is that can you 1031 a single family residence to convert it either of above? Yeah, as long
Yeah,
as
of
the
course.
ownership structure is set up the right way.
Mhm.
I can tell you right now that I think we're going to have some 1031 money coming into our first deal. So we have to structure it as a tick, or at
Mhm.
least partially as a tick.
Mhm.
So that's the Oak Brook Hills Resort. There it is right there. You guys, let me see. Do you guys look into office apartment conversions? We've looked into it. And, I know that if you look at some of these locations, these office buildings, if you go on, the Crexy, the 10X, the number of office buildings going up for foreclosure and auction is amazing. The locations are fantastic. It's just converting them, and that's a huge lift, a very huge lift. Just
Mhm.
even in the shape of the building, it makes it hard to put those. Remember that. Like Michael, this he knows mill buildings. Mill buildings are long and thin. You can put the hallway just like Lofts 34. He knows what I'm talking about. Long hallway down the outside, and the apartments go to the windows in the back. But these office buildings are squares, big, huge squares, and there are no windows on the inside. That really creates a strange bowling alley in the middle.
Yeah.
Let's see. Let me see. I would be interested. Okay, I would be interested in bird dogging for a fee agreement. Well, send me your agreement, Leo. What do you think? I'm going to do all the work for you? Send me your agreement. Let me take a look at it. Let's see. I'm looking at office property near the upcoming event. Good. Come on in, Win. It'll be great to have you. All right, everybody. Great to see you all. Thank you so much for coming out on this beautiful Monday. I've got my Monday Night Live call with all my students tonight from 7 to 8 p.m. So for those of you who are my students, I look forward to seeing you there. Probably going to be talking about some of these numbers just to give you a better handle on how they all work. And actually David would probably be teaching students tonight exactly how the quick analyzer works, so they know how to figure it out on their own. So, all right, I guess Alex started it and I will end it. Okay, hold on. Ella asked a question. What is the minimum fund required to participate in the conversion partnership? You know what, Ella? It's going to be different for every deal. And, some deals you'll say, it's too rich for my blood. Other deals say, yeah, put me in that deal. So it's going to be, we're not saying you got to put in 50. We do. There is a fee to get into the fund, to get into our partnership. It's not an investment. It's a fee. And also, this is not a security. You will be investing as a partner. So you will be a co-equal with all the other partners, a joint venture, not a limited partnership. That's not how we're going to make our money in this deal. Everybody's going to share and share alike. And that's the structure. All right. Arrange at least.
Well, Ella, just think what can you contribute? Can somebody contribute management? Can somebody find the deal?
No, she's talking hard, cold cash.
Hard, cold cash. I mean, it depends on what you got your partners agree to, right?
It's really, Ella, I can't give you a number. I mean, it's not $1 million, but it's probably, definitely north of 50. So anywhere in that range. But everybody's going to be different. Sometimes we'll bring in more partners and other things to get the deal done. But the whole point is that we're going to be partners together in the deal. We're not going to be
right. We're not looking for 20 people in a partnership.
Yeah. Look at Steve Pasquini. He knows I'm a visionary. He knows that that's the way. Enough of these, there are going to be a whole lot of limited partners who thought they're made, they put theirs and their friends and families' retirement dough into multifamily investing and for passive gains. And with what's going on in the multifamily world over the next 5 to 7 years, they're going to be in for a rude awakening. Good luck to them. We know the right model to have is this one. And we're going to start taking off on this one. So, all right, everybody, thank you so much. And we are going to end the broadcast. that focused on project management. Yeah, exactly, Wayne. You see, you'd be a good partner. Bring your cash too, though, because Alex is going to assume everything. Yeah, he's going to assume victory because he's an economist. Okay, everybody, great to see you, gentlemen. It's always a pleasure to see you, and we will chat later. See you in Chicago.